One decision in Washington just changed your debt, your savings, and maybe even your job. But here's the crazy part. Most people have no idea it happened. On September 17, 2025, the Fed cut interest rates for the first time in over a year, and that one move could flip your money game forever. Sounds tiny, right? Just 0.25% cut. But stick around, because in the next few minutes, you'll see how that small shift can lower your credit card bill, shrink your car loan, slash your savings return, and even decide whether your boss keeps you on payroll. Let's break it down. So what exactly is the Fed rate? Officially, it's called the federal funds rate, the short-term interest rate banks charge each other to lend money overnight. Doesn't sound exciting, right? But it's the anchor of America's money system. Move it, and the entire financial ocean shifts. Here's how powerful it is. In the 1980s, inflation was so wild a movie ticket doubled in price in just a few years. The Fed raised rates above 20%. Painful, but it crushed inflation. In 2008, the financial system was collapsing. The Fed cut rates to nearly zero to save jobs and stop a depression. In the 2020s, after the pandemic, inflation roared back and the Fed hiked aggressively again. Every move is like adjusting the thermostat of the economy, turning the heat up or down. The Fed moves rates for two reasons. When inflation is too hot, they raise rates. Borrowing gets expensive, people spend less and prices cool down. When jobs or growth are weak, they cut rates. Money gets cheaper, businesses borrow more, hire more, and keep things moving. Think of the Fed as the thermostat in your apartment. Too hot? Crank it down. Too cold? Turn it up. But here's the twist. The Fed isn't the only player. Monetary policy is what the Fed controls, interest rates, and the money supply. Fiscal policy is what the government controls, taxes, spending, and stimulus. In 2008, the Fed cut rates while Congress bailed out banks. In 2020, the Fed cut again while Washington sent checks to households. One sets the price of money. The other decides who spends it and where it goes. Together, they shape your financial life. So how does this hit you? Start with debt. Credit cards, auto loans, personal loans, and adjustable rate mortgages are tied to the Federal Reserve. When the Fed cuts, these costs usually fall. Example: if you're 25 and carrying $5,000 in credit card debt, this cut could save you around $100 a year in interest without you lifting a finger. But mortgages? They play a different playlist. 30-year mortgage rates follow the 10-year Treasury yield, not the Fed directly. So yes, a Fed cut might nudge mortgage rates lower, but it won't slash them overnight. Translation: don't expect your dream house to suddenly get affordable just because Powell makes a speech. And while borrowers cheer, savers groan. That 5% CD or 4.5% savings account? Banks usually cut fast. Why? Because they can borrow from the Fed for cheaper, so they don't need to pay you as much. If you've got $10,000 in a savings account, this cut could quietly shave $100 off your yearly interest. That's the flip side most people miss. But here's the real game changer. It's not just the rate, it's the relationship. If inflation is 3% and your savings earns 2.5%, you're losing money in real terms. If inflation drops to 2% and your savings still earns 2.5%, you're winning. Always compare your return to inflation. That's the difference between keeping up and falling behind. The Fed's real focus is job. Lower rates make it easier for businesses to borrow, expand, and hire. That helps avoid layoffs. For investors, cuts often boost stocks and bonds. But here's the catch. If inflation lingers, those market gains can vanish fast. It's always a balancing act. Quick challenge: if you had to choose lower debt payments or higher savings returns, which would you pick? Drop it in the comments. I bet most people say debt, but wait until you see why savers actually get hit harder in a rate cut. Here's the bigger picture. Your money life is like a machine made of gears. One gear is the Fed rate, another is inflation, another is fiscal policy. Others are your credit card, your savings, your mortgage. When one turns, they all move. The problem? Most people don't even realize they're inside this machine. So what should you do when the Fed cuts rates? 4 moves: debt, refinance, or consolidate. Even small drops save big over years. Savings, lock in a CD before yields slip. Home buyers, watch bond yields, not just Fed headlines. Investors, cuts often fuel rallies, but inflation can still eat your gains. This one decision in Washington just flipped the game. The question is, what will you do differently? You don't control the Fed, but you do control your response. Most people ignore this until it hurts them, when their savings shrink or their debt snowballs. Don't be that person. Understand the rules, and you'll move with confidence, not fear. Like this video? Subscribe to Clear Path Gen for more financial clarity, because when the rules of money change, you deserve to know how to play the game.